All right, good morning, everyone. Welcome to a good sized group. We've got 27 of us. Welcome to the trade findings and adjustments for the 6th of January 2022. Just in general, I would like you guys to tell me, what are your thoughts about 2022? If you're going to think about a new year, what are your thoughts? Yes, I did go shut a door. What are your thoughts? It's better be better than 2021 and 2020. That is funny. I like that one. What else? 2020 year will be the year I double a portfolio. That's awesome. Rich, what year was that for you, if I may ask? And you don't have to answer if you don't want to. Bill, I'm waiting for a good comment from you. You always have something for me. Jimmy, Bill and I have a unique relationship. Sarcastic, humble, obnoxious, and laughable all at the same time. You know what? That is a very interesting take, Dave. And you know what? I'm probably going to focus on that. So I'm going to hold off on making that comment just for a sec. Why not? Let's do it. Dave made the comment, it's not like 2020 and 21 were bad, but I expect better. And I think that's very insightful, Dave. This is actually going to be a two-part series. I'm really just going to I'm going to focus on these three things, but number one is where we're really going to focus our energy today. I consider successful investing, or I should say, successful investing for me is making money consistently over a period of time. So successful, making money over a period of time. And that period of time for me has been in that 4 to 5 year range where we've been able to double portfolios. I don't want to lose. With that said, I'm okay with losing if I am gaining shares to come back later. Right? Hurley philosophy, plain and simple. And let's face it, with my ego, with my personality, I'm also a big fan of, if you show me a good loser, I will show you a loser. Now, I'm not saying you should have sportsmanship. There's a difference between good sportsmanship. But if you show me someone that's okay with losing, I'm not going to understand that mindset. I'm not going to understand being okay with losing. If it doesn't hurt, if it doesn't make you better, if you're not going to make changes, tweaks, look at your methodology, adjust things. If you're okay with losing, the stock market is not for you. And I'm going to politely say, if you're okay with losing, I don't like to associate myself with those type of people. I'm someone that believes in accountability. Accountability, whether it's for me or against me. I need accountability in my life to be happy, plain and simple. I've come down to 3 points that are the crux if the US stock market is for you. And if you don't understand these 3 points, you should be in an annuity. You should be in a bond, and the US stock market or any stock market is not a place for you. Number one is what I've just done for the last 3 weeks. Work your own numbers and never take someone else's work as your own. This comes down to the whole premise of CNBC and CNN and Bloomberg, the big market crashes, education. People have not learned to do the work themselves. People, traders, investors are looking for the next best thing and looking for a shortcut. Can someone please tell me out of the, well, we're down to 24, so I already lost 3 people. That's not good. Would someone please tell me out of the 24 people that are here, when has a shortcut truly ever worked out for you in life, in business, and investing? Does anyone have an experience that they might want to share? Or, well, I just had 3 no or never happens come in, right? Right off the gate. So there you go. 10% of you are like, no, doesn't work. Truly, if you're looking for a shortcut to the hard work, to these glorious returns, really, it really exists. I like the next 2, well, the next 3 I've just got in. Never happens for J&J. And not smart. So for you 3, thank you. So 6 of you, we've got 20%, well, or 24, 6, 25% understand right now that there aren't shortcuts. Man, I wish Lance back in the day, you understood that. With that said, number 2, once you've proven your methodology, enjoy the process. It's amazing how many people look at collar trading and they're not happy till the end of 3 years. They're not happy till the end of the 4.5 year when some things have come back, some shares have been added, you know, boom, we somehow look like a genius on the 3rd year. And there's been 2 years and 11 months of apparently hell for someone. And I scratch my head and it's like, you know, if you can make up some of the downward movement, if you're not taking the full loss, if you can understand the methodology and where you're trying to get to, why can't you look at the roses along the way? It's interesting. I do a lot of hiking, and there's a difference. And I'll be honest with you, I'm 277 pounds. I'm 6'1". My pack is too heavy because there's too much stuff I want to do when I get to my destination. Hiking for me is a strain and a struggle. I hate the first 2 hours. The first 2 hours, my legs are getting used to it. My pack is heavy. There's something that's hurting on me. It just every ache and pain I find in my body finds me in that first 2 hours on a hike. And our incline could be next to nothing. Our incline could be, you know, as little as 100 feet per mile, which is nothing. And my body's like, oh, it's 1,000 feet a mile. It's just so hard. And there's some people that are trying to get through it and will get through it by just looking at the feet of the person in front of them. They take a step, I take a step. They take a step, I take a step. You hike in these groups so that your leader will get you in the right direction. Your pace setter behind the leader will keep everyone together. And then those behind are really looking at people's feet in front of them to just step when they step, because it's easy to just focus on that, not the pain, the hurt, the aches and whatever. And they miss the beauty of the whole hike in the first place. Well, Kevin, are you saying investing in the stock market is a hike? It is. Investing in the stock market is a hike. That's all it is. And the interesting part about it, I'm held against the S&P 500, right? This is my hike. Up a little bit. Oh, I'm killing me. Down. Up a little bit. Down a little bit. Up a little bit. Oh, it's down. Oh, there's a big hill. Ah, a little bit of rest is going down. Yeah. In all honesty, the stock market is definitely a hike. And if all you're focusing on is the pain during the downsides, right? Looking at every single day, man alive, the stock market is not for you. It sucks. I would hate to be you in the stock market, because in that 6-month period of time, 1, 2, 3, 4, 5, 6, 7 times for over half of this time period, you're absolutely hating it on a gaining S&P 500. Well, Kevin, there's diversification in different stocks. Yeah. Each one of these 7 downturns could be 7 different stocks in your portfolio that go through a downturn, which something in your portfolio is down this whole 6-month period of time. And if that's what you're focusing on, the stock market is not for you. We'll get you into an annuity, we'll get you into an insurance product, we'll get you into a bond fund. Technically, you won't lose any money, but you won't make any money either. But it's better for your health. Last but not least, if you never understand that averages are not your friend, that we live in a variable market, you will never understand the stock market. If you think averages are important, if you speak in averages, if you use averages to justify stock ownership, portfolio growth, account growth, you truly do not understand the market that you're in or the importance of variability. You believe in possibilities, but you haven't understood probabilities yet. Today, I'm going to work on number 1. I'm going to work on number 1, and I got an interesting article. Now that we're moving things over to Schwab, and what a chore that's been. Schwab has an interesting article, how to pick stocks using fundamental and technical analysis. Are there some other analysis we should be using? Fundamental, technical, what other analysis are there? Sentimental, there you go. We have a 3-legged stool with Bill Sentimental. And perfect. And market analysis, right? There are probably your stool, your base, your support for being in the market should be some kind of mixture of fundamental, technical, sentimental, and I'm also going to say market analysis. Market analysis is rarely used or commented on, but if you're not looking at the stock market as a whole, not looking at other markets in the United States as a whole, if you're not looking at the fact that we're a global economy now, you're missing one of those stool legs that can really make your stool a steadier, stronger stool from a 3-legged stool to a 4-legged stool. And the funny thing is, I really enjoyed the article because they talk about what fundamental analysis is, what technical analysis is, yet their big preference, or what they're really trying to tell you, which type of analysis is right for you? It's both of them. It's all of them. It's all of them. If you're just a fundamental trader, you're screwed. You're only using 25% of what's available to you to help you make your best educated decision. If you're just a technical analysis guy, well, then I think you're actually only losing about 10% of the analysis that's available to you. If you're just a big value stock market analysis guy, if you're just a sentimental analysis guy, if you're just, what's the word for them, where they just disagree with everything. If you're a something trader, if you're a going against the grain trader, I just brain farted what the word is. A contrarian, thank you, Bill. If you're a contrarian trader, you're missing 90% of what's out there to help you. It's amazing. Technical, fundamental, sentimental, macro market analysis is always the first thing that any education pushes to someone. And it's the least amount of effort and time spent and understanding and use that people do. The main foundation, the main basis of everything they should be doing is spent the least amount of time on in their education. It's the least amount of their time when they're actually trading. Talk about trying to shortcut the process. I'm going to build a house on sand because I don't want to take the time to go and mix concrete. I don't understand it. For me, a great article, please go through and read it and enjoy it. For me, I created my own little fundamental checklist. It goes with about everything that anybody has ever used. I want to check 10 or 11 out of the 14 boxes, just meaning, hey, institutional ownership, is it over 50%? If it is, I check my little happy face. Is there more than 1 million shares traded daily so it's liquid so I won't get caught and not be able to get out of a trade? I check it. Do they pay a dividend? It's not a make or break, but I count as one of my 14. I like getting paid money. High or low? Are they 10% off their low or 10% off of their highs? Is there growth for that stock? Debt to equity. It's interesting. You have to compare it to the industry. Obviously, 0 is the best to have no debt to equity. But is their debt to equity higher or lower than the industry? Is it higher or lower for their sector? Is it higher or lower than an average S&P company? I want to check it off to make sure that it's a good, fundamentally sound company. Overall debt, do they have cash on hand? Can they grow if they need to? I want to see positive revenue growth rates over the years. Kevin, well, what if, 2008, what about 2019, 2021? Well, yes, I'm making my best educated to guess. So could there be a year where there is not a positive revenue growth rate? Of course. But if I can look for a general trend, I mark it. Do they have earning surprises? Would someone please tell me why this is so important? Why am I looking for earning surprises? And why would it be a fundamental checklist item that I need if I'm going to invest in them? Someone please tell me, why is an earning surprise so important to Kevin at Hurley Investments for the type of investing that we do? Boy, I'm making you guys think, huh? You're going, man, I never knew the first time back the webinar is going to be an education. Is going to make me think. Wow, I've got 4 comments that just came in. I love them all. Protection abilities. Yes, the short answer, what Bill's trying to say, you're looking for movement. a requirement for collar trading is movement. We make money if it goes up. We'll make a large amount of money if it goes down and then goes back up. We don't make money as it goes sideways. So the other comment is you can't trade sideways, which we can. We just don't do a good job of it, kind of like last year, right? You're looking for big movements to pick up more shares. Bingo, I love it. You're looking for movements for protection on the long put. I love it. I need my stocks to move. If they don't move, the method of trading where we're going to protect for that 83% of the time that a stock can move 10% more over a 6-week period of time, 2 weeks before earnings, 4 weeks after earnings, I need it to move. That's what I'm paying money for protection. If I'm buying that long put and they're not moving, we don't have earnings surprises, we don't have earnings misses, the stock is not a good candidate for collar trading. Profit margin. I want to see growth, and not only growth in the profit margin to the company itself against the industry sector and S&P 500. PE ratio and PEG ratio both have to show growth, and not ridiculous growth, but realistic growth compared to the company, the industry, the sector, the S&P 500. I look for sector growth. I don't want to have an outlier in one sector that seems to be growing right now. You know, a single company in a sector growing. Why would I not want to do that? Someone tell me, why would I not want to be in the single company in the sector that's going down, but it's just killing it? Why would I might not want to be in that particular company, even though it's beating the sector, just killing it, maybe even 100% return, but the sector as a whole sucks? There you go. Bingo. Low tide sink all ships. Who was that? Dave. Low tide sink all ships. That's amazing. That is a word for word. That is exactly what I was thinking. Well, Kevin, the low tide's not sinking the ship right now. It's an outlier, and usually I have noticed in my 27 years of investing now, I've noticed if there's a single ship that's killing it in a sector that's just in the tank, usually find out there's some funky accounting going on, there's some falsified numbers going on. I am a firm believer low tides will sink all ships. Ranking the industry, again, I like the top of the barrel type of companies, not the bottom of the barrel. This is what I've been doing for all of our stocks and for what we're looking at. Beta, I also look at the riskiness of a position. And it's interesting because someone said, hey, could we do this work that you're doing? Would you do it on TMO? And do I have that correct? James, this was TMO, right, that we were talking about that I said I would do for you? Kind of not a good time to be asking, because if it's not, I've just prepared everything on the stock that's not there. All right, thank goodness. So TMO was asked to me, hey, Thermo Fisher Scientific Inc. It's in the healthcare, diagnostics, and research sector. Kevin, would you invest in TMO? I usually get my original numbers from FinViz. This is where I'm looking for numbers right now. There are 24 of you here. If some of you have some other places, would you please type in where you get your research from? But I will go from TMO. I will go with E-Trade's basic research stuff here, right? I will go to Yahoo, finance.yahoo.com. I will go to googlefinance.com, and those are probably the main four that I will spend my time using. But I usually will start with FinViz only because right here, I've got a lot of what I need out of the gate. Right now, today, this sucker is trading at 622.35. That's what I'm going to use. I'm going to refresh it so we get relatively 622.05. So as I'm looking at right here, I'm just start to put in information 622.05 stock price. Here I am looking at where I'm going to be. Institutional ownership. For me, it has to be above 50%. I want to see big money in this this company. I'm not interested in trading it if there's not big money that's there helping. Oh my gosh. How do I hide that lady? I don't want to see her ever. Here we go. Institutional ownership. 90.2%. Out of the outstanding shares, 90% of their shown shares are owned by big institutional traders, which tells me someone bigger than me has done research on this company. 90.2%, it's a definite check mark that I'm saying, yes, I'm on it, I'm using it. Average daily volume, I want it more than $1 million. I don't want to not be able to sell shares. I don't want to be able to, well, I don't want to be stuck in a position where I can't make money. I can't get out of it if I need to. I can't get myself back into some of my stuff. Daily trading volume, let's see. Daily trading volume. Average volume I have hidden right down here. Sometimes it's a 10-day. Sometimes it's a 30-day. Average volume 1.2 million. Relative volume 1.34. I will go and check some numbers in different areas. I do still use, where'd you go? There we go. Thermal Fisher, I still will take a quick look here. This is a 10-day average volume, 1.149 million on a 10-day average. I like it. I will check out Thermal for summary. And I also will check it here on Google Finance. Volume, they say 1.41 million. That's probably over a 30-day. So I'm just verifying my numbers. I'm not just going to go to one person's numbers to say, hey, you know what? This is what I'm looking at. This is where I'm at. But the short answer is across the boards, I'm having a little trouble on the one there. 1.149 to 1.4 million on a 10-day to 30-day average. Works for me. I'm getting to come. I got 2 out of the 10 to 11 checks I need. Dividend. Do these suckers pay a dividend? Oh, why is that so not working? All I want is the summary. Get it done. All right, I'm also going to try to shut some of this down. We might be having kids on the internet doing their schoolwork. All right, what was I just looking at? I was looking at dividend, sorry. Looking for the dividend. Do these guys pay a dividend? Kind of check right here. They do. They pay not a very good dividend, 0.17%. It's $1.04. That is a pathetic dividend. Usually want it between 2.5 and 4, maybe even 2 and 4. So yes, they pay a dividend, but they're only going to get like half a check mark. That is really not. That's pathetic. That's almost like not paying a dividend. It really is. That's bad. High-low is their growth and their recent stock price movement. Are they within 10% of their highs or their lows? And it's interesting because this could be a quick little check. Well, their lows for the year were 440. Their highs were 680. They just lost 10%. The company's 10% roughly off their highs. This checks out. Yes, they do have a 10% growth. 10% roughly off the highs. They recently just showed me that they've got a 10% growth opportunity from where they most recently were trading at. Debt to equity. Now I've got to start doing some more work here. Debt to equity is a bunch of different numbers you need to check at, right? Debt to equity. Where's my debt to equity? Debt to equity right down here. Second column. I'll highlight it for you. For every dollar they make, they spend 56 cents on debt to equity. Well, for diagnostics and research and for healthcare, in my head, that seems okay. That seems pretty decent, pretty reasonable. I don't know, though. In real life, I don't know. That's where I come over here to Yahoo Finance, because they say, hey, Danner Corporation, Stryker, BDX, Illumina, you know, they've got a bunch that are here. I've already done this research, so I said, you know what? Some of their competitors are DHR that I've never heard of Danaher Corporation. Well, they're half the cost, but looking at their debt to equity, that's a related industry, right? Their debt to equity is 0.59. So right now, TMO falls in that space of, you know what? It seems pretty good. Their debt to equity is in line. For Danaher Corporation, which is a healthcare diagnostics research, I like it. Let's try something like BDX, right? I've never really heard of whatever Dixon Corporation, Becton Dixon Company. Their debt to equity is 74.72. Huh. Okay, pretty interesting. We seem to be in line for everything. Let's check BAX, right? Never heard of the company, but Yahoo has them. In that care, medical instruments and supplies now. Debt to equity 62 to 68, 0.62 to 0.68. Then kind of went to a couple interesting ones. I know Medtronics. I've traded them. They're in my state. I know Medtronics in a way is healthcare medical devices. They're at a 0.49. And then what about Boston Scientific? This is another company that I know, that I look at, healthcare medical devices. They're at 0.55 and 0.54. So I just went through verifying that in their sector, their industry, 0.56 reasonable. Their debt to equity is okay. It's reasonable for what I see in the industry, in the sector. I like it right now. 4.5 check marks out of the first 5. They're looking good, but they're expensive. 622, I need 300 shares to make my collar trading work. They're expensive, but can I justify what they're doing? Overall debt to equity, we actually just did that too. 0.54, reasonable. Revenue growth rates. I'm looking for a time frame to see growth in these companies. I'm now starting to do social science research, right? I'm now taking a look and seeing earnings per share next year, 15.93. Next 5 years is 23. Past 5 years has been 14.6. Past 5 years, 14.6. Next year, 15.93. 23 earnings per share over 5 years. I like it. It seems to be growing, right? Return on assets, 3.5%. Return on equity, 6.9%. Return on investment capital, only 0.3. Gross margins look good at 67%. Operating margin at 9%. Profit margin at 9.6%. Hey, Boston Scientific, I've got something I know that shows me something good. Now let's go put that off against Thermo Fisher Scientific. Let's see if we come up with some of the same things. Earnings per share next year, negative 7.52%. Earnings per share of the next 5 years, 11.8. Earnings of the past 5 years, 2.650. Past, they made a 26% earnings per share. Next year, they're going to lose money. In the next 5 years, they're going to halve their growth rate. Return on assets, 12.4%. Return on equity, 2.36%. Return on investment capital, 12.3%. Gross margins are higher. Operating margin, profit margin, all looks wonderful. But your story you're being told, last 5 years justifies their high growth rate. Next year, they're expected to lose money. And the next 5 years, they're less than half of the past 5 years growth rate. Is that a company you want to be invested in going into the future? And there's still 24 of you here. I expect every single one of you to answer me on that one. Are you looking to invest in a company that the past 5 years, it's up 26.5%. Next year is expected to be down 7.52%. And the next 5 years, it's only going to go to an 11.8% growth rate. James, we're going to have a talk. The growth potential is the wrong direction. This will be a big one for me. If I look at this, 26.5 going to moving to a negative 7.52 with 5-year 11.8. It does not have a positive revenue growth rate. There is a problem here. It justifies why they're at 622 right now, but it does not justify why it's going to go higher in the future. Well, Kevin, it's COVID, it's this, it's that. I don't care what it is. Yes, you can justify it, but it does not have a positive growth rate. I cannot give it a check mark right here. In fact, if anything right there, I need to give that one a great big red. Hey, not good. Not going to work. Earnings surprises. Kevin, where do you find earnings surprises? There used to be a couple different places. Earnings surprise data. Let me go to, is it the Benzagi Pro? It's usually Seeking Alpha, but that's a subscription. NASDAQ, I think this is where I've got it in the past. Is it stock market? No. Is it Zacks? No. Could be. I've got another place. I usually don't use Zacks, but earnings surprise. Actually, it's in briefing, and I took care of briefing. That was done. Briefing.com. This is where I get my earnings surprise checklist, so to speak. I go to TMO. If anyone knows of a better place to check for earnings surprises, please let me know. Oh, come on. Search. Do I really got to sign in? Earnings. Well, I'm not finding it where I want it to be. TMO. I think I have it a little bit better prepared than this. All right, I'm gonna go over to earnings surprises. Not gonna find it here either. Well, the short answer is, I've already done my research, so I'm cheating. Do they have earnings surprises? They do not. They don't move their earnings surprises a ton. It moves less than 3%. All right, profit margin. Now this is where we're going to start getting into positions again, right? Profit margin, growth compared to industry sector S&P 500. We've already compared it a little bit to Boston Scientific. Operation margin, gross margin, profit margin, 21.9%. We like it. That is good. It's going to get an X. Growth compared to industry sector, PE ratio. So this is another interesting one. The PE ratio is at 28.70. DHR is at 38.3. BDX is at 36.8. BAX is at 36.9. Medtronics is at 30.4. Boston Scientific is at 36. Believe it or not, technically speaking, their PE ratio related to their sector, their industry, 29, is lower by a third. Well, isn't a lower PE ratio meaning more growth? Again, this is a social science. I'm telling you, their growth does not look positive for the future. PEG ratio, same thing. Lower than the industry by a third. Well, Kevin, lower's better usually. Okay, usually it is, but not in this sector. Return on equity growth. Company, industry. Is healthcare growing? I'm going to ask you as a general, is healthcare growing? What do you think? Is healthcare growing right now? I've got 2 yeses and 2 no's. Well, I kind of think the baby boomers are using up healthcare, right? I think COVID is using up healthcare. I think healthcare in general is growing. We've got some no's. Well, it's all COVID. We're not doing elective surgeries. We're not building the machines, right? It's kind of 50-50. If you were to ask me, I really don't know. It's going to get another half a check mark. And I looked at the ranking in industry and the company. It's not a relatively high ranking. And then the last one, beta, compared to the S&P and 500. This is a very interesting self-serving question. Beta, what is the risk compared to the S&P 500? The S&P has a beta of 1, right? What is the beta of Thermo Fisher? The beta is sitting at 0.74. It's 25% less risky than the S&P 500. Well, Kevin, what does that mean, right? What does that mean? What are you trying to say? Well, you look at Apple, right? Apple's got a beta of 1.2. That's 20% riskier than the S&P 500. You look at Boeing. Boeing of 1.51, right? Oh, that's 50% more risky than the market. You look at Ford. 1.10. Oh, it's 10% more risky than the market. Let's look at Facebook. 1.29. Bank of America. 1.51. Man, Thermo Medical, whatever it is killing it compared to what you trade, Kevin. Right? It's killing it. Everything else, not good. But then you compare it to DHR, this other healthcare, whatever we're talking about. 0.7. BDX, 0.71. BAX, 0.64. Medtronics, my own I put in there because I know it, right? Come on, Medtronics, get in there. Medtronics, 0.81. It's riskier than what I like. Boston Scientific, 0.87. I don't know. Compared to the industry and sector and the S&P, 0.74. It's higher than DHR, it's higher than BDX, it's higher than BAX. What I do know of MD, MDT, and Boston Scientific, yeah, it's better than them. Slow mover. It's a slow mover, which goes into their earnings surprises, right? They move less than 3%. If I was to use a covered call strategy, a protected put strategy, I might not make my money back on them. Total numbers. 1, 2, 3, 4, 5. 5 no's. A half. It's kind of funny. I got half a point, right? 1, 2, 3, 4, 5, 6. I've got 7 yes, and I've got 1 undecided. I have just spent the last 45 minutes with you, and usually I can get this down to 25 to 30 minutes, but I have just come up with what I've just spent the last 3 weeks doing on about 455 stocks. My conclusion, no, I would not invest in TMO. And guys, this is what I've been doing the last 3 weeks. I've been going through this with Square, which is now called Block, and PayPal and Bank of America, and just going through everything so that I don't miss fundamental, technical, sentimental, and macro market research. I really like it when I have 9 yeses, 10 yeses, 11 yeses. That's what makes all of this worthwhile. this is where I would be at for TMO. Bill just said, how do you do that while hiking and fishing? Well, I look at my phone, and believe it or not, if I'm fishing by a lake, but right now there's a foot of snow outside, right? I'm in my ice tent with my phone and my computer, and I still use paper. And I just go back and forth and check these numbers. And I fill it out, and I still scratch a little X on it, and there we go. I've got a really interesting article on 10 economic trends that could define 2022. The baby bust. Boy, I thought that was hilarious, right? Really thought that was hilarious. Peak China, the debt trap, not the 70s, greenflation, productivity paradox, very interesting. Data localization, bubblets deflate. We're not going to have a big bubble go down, but there's certain areas, bubblets, that'll really cool off. Retail cooling, physical matters. A very interesting article that will look at your thought process on where things could go in 2022. But I was trying to show you today how you work your own numbers. Don't listen to someone in education. Don't listen to someone on TV. Don't listen to your money manager. You do your own work. You don't listen to your boss if you're me. You don't listen to Schwab. You work your own freaking numbers so that when a client asks you, what about TMO? You've got your hard numbers right here that you can say, you know what? Eh. 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 I don't see it, right? Eh. Couldn't do it. You work your numbers so you know what they're telling you, not what someone else is telling you. I'm going to talk to you on Monday about 2 and 3, why they're so important and why things are changing a little bit. And with that said, are there any questions you guys have for me? And this really comes to James, Rich, Bill, you guys are all education. Dave, David, W, Lance, Mary, this is education. Where'd that gal go? The gal I've already welcomed you, and I forgot your name, and I don't see you in the list right now, but you're probably here. Does this help you guys in any way, shape, or form understand how you should be working your own numbers, or especially if it came from education, how important this research should be versus just wildly throwing stuff on? Dave, you are my favorite today. Only because you just typed in yes. I'm sure the rest of you are typing, but I do hope this was helpful for you. I will send this out. If you are interested, you can always send me an email, khurley, Hurley, at hurleyinvestments.com. I can send you the worksheets that I use. It's something I created. Boy, Bill, was this safe option strategy? No, this was probably spread trade systems. This is something I created 2003, 18 years ago. and I'm still using it today. 18 years ago, and I'm still using it today. It's something that allows me to make sure I work my own numbers to justify that that I can tell you why I'm invested in something. If you've ever gone through an education, this is what you should be doing. If you have other money managers other than me, this is what they should be doing. And I'll bet you 999,999 will not work their own numbers. They'll just look off of a sheet and think they've done the research themselves. Guys, I appreciate seeing you here today. There it is. Thank you, Josephine. I appreciate you saying that. Josephine was like, how can you miss me? My name's right here. It's a list of 24 people today. It's kind of large. So I'm great. Thank you for letting me know it was helpful for you. This is where it's at. If you're not starting here, I've got to question why you're in the stock market. If the first step, the first level is gathering information to make your best educated decision, it's what has to be done to truly be successful in investing. Guys, I appreciate you being here. My pleasure having you here today. I look forward to next Monday evening. If there are any questions, khurley@hurleyinvestments.com. I can send you some PDFs, which are these fundamental checklists that are also blank, so you can fill out yourself, and with the reasons so you can see what I'm looking for. I do hope this was helpful for you guys to understand what work we put in here and what we've been doing the last 3 weeks. I wish I was able to hike or fish more, but you know what? It's been pretty easy, and I kind of feel that if I can work a 40-hour week, I should be working a 40-hour week. And this has been hours of the last 3 weeks. I mean, we're talking 50, 60 hours a week, making sure I'm prepared to have you guys invested in things that the numbers work out for me. The one thing we should have really done, so let's do it right now. I should say possible. Possible this year's, well, really possible this year's stock price would be the best way to say it. It comes down to nothing more, and I've shown you guys this in the past. It comes down to nothing more than saying, I guess a reasonable PE for these guys is what, 28.7, right? On their earnings per share next year, 21.73, huh? So let's go ahead and take 28.7 times 21.73, $623.65. All I'm doing is taking what a reasonable forward PE, actually that's 28.47. 28.47 times next year's 21.73. A reasonable price for the next year's growth, 618.65. That's the low end. If we bumped them up to 30, just because that's where the other ones were in relation, a little bit higher, you know, 34, 36, 30.40. If we kind of bumped them up thinking they could be more in those other people's range, 30 times 21.73 gives you a 651.9, which doesn't get them back up to the $680 mark they were at most recently. So as I look at these guys and I calculate future growth, their future growth does not look to be even where the highs of last year were. kind of interesting to think that. And that's where I would find a hard time finding a way to invest in these guys if their current PE gives them a 618.65, and if we raise it to maybe something a little more realistic of a 30 PE, we only get to 651.90. Right now, currently fully valued and not worth the next year's purchase at this price. All right, guys. Hey, good times. Appreciate you being here. You guys have a wonderful weekend. It's my wife's birthday tonight, so we're taking her to a BYU college football game, pastrami quesadillas, and man, is it glad to be back with you. Look forward to seeing you on Monday. We'll finish this up. Have a great weekend again. And guys, until then, I'll see you next week. Bye-bye.